All right, let's talk about a simple little rule that basically became the secret handshake of Silicon Valley. It's a metric that can shape billion-dollar decisions for software companies. We're diving deep into the Rule of 40. So let me ask you this, because it sounds kind of crazy, right? How can a company be burning through millions of dollars, just absolutely deep in the red, and still have investors lining up at the door calling it a healthy investment? Well, that exact puzzle is what the Rule of 40 was built to solve. You see, to really get the rule, you've got to understand this fundamental problem at the heart of every software as a service, or SaaS, company. It's this constant, high-stakes battle between two completely opposite goals. So on one side, you've got this siren song of hypergrowth. The whole game is just get big, fast. You want to capture the entire market before anyone else even has a chance. The problem? That burns an insane amount of cash. But on the other side, you've got profitability. Being responsible, saving cash, staying in the black. But if you're too careful, some faster, more aggressive competitor is just going to come along and completely eat your lunch. So investors desperately needed a way to look at both of these things at the same time. And right out of that chaos, a surprisingly simple and, well, elegant solution started to bubble up from inside the venture capital world. It was this informal rule of thumb that very quickly became the entire industry's secret formula. Now, the Rule of 40 wasn't invented by some genius in a lab. Nah, it grew organically. It was more like collective wisdom from investors who were all just trying to figure out this SaaS explosion. And then, in 2015, this venture capitalist named Brad Feld wrote a blog post about it, and that just launched this insider metric right into the mainstream. So what is it? Honestly, it's beautifully simple. You just take a company's yearly revenue growth rate as a percentage, and you add its profit margin. If that number is 40% or higher, the company is considered healthy. That's it. That's the whole formula that now drives these massive, multi-billion-dollar decisions. And this is where you can really see the genius in its flexibility. A company can be healthy in a whole bunch of different ways. You could be a break-even star, growing at a solid 40% with zero profit. Fine. Or maybe you're a mature cash cow, growing slowly at 10% but throwing off a huge 30% profit margin. Also fine. And then look at that last one, the aggressive grower. That's our company from the start, growing at a blistering 60% a year but losing 20%. Under the Rule of 40, all of these companies are seen as equally healthy. Okay, so we've got this simple little formula. Now let's dig into how it became such an incredibly powerful benchmark that literally shapes how companies are built and how they're valued. And here's why everybody, and I mean everybody, pays attention to it. Money. It really comes down to this. Companies that hit or beat the Rule of 40 can get a valuation that's up to 154% higher. That's more than double the value of a similar company that misses the mark. So yeah, when that much money is on the line, the rule stops being a guideline and starts feeling like a command. What's also interesting is that the rule's importance really changes as a company grows up. For a tiny startup, hitting 40 is just a dream, an aspiration. But once it hits that growth stage, being able to meet that number signals to investors that, hey, this team knows what they're doing. They can balance growth with discipline. And then for a big, mature public company like Salesforce, it becomes this critical, ongoing test of their long-term health. But, and this is a big but, for all of its elegant simplicity, the Rule of 40 has a dark side. The very thing that made it so popular, how simple it is also its greatest weakness. And believe me, the cracks are really starting to show in this once perfect formula. This brings us to this great idea called Goodhart's Law. It basically says that the moment a measure becomes a target, it stops being a good measure. People will start gaming the system to hit that number, even if it means doing things that are actually bad for the business overall. And that's exactly what happened. The Rule of 40 became the target, and that's where the problems really began. So here is the rule's biggest, most fundamental flaw. It assumes that 1 point of growth is worth exactly the same as 1 point of profit, but the market, it just doesn't see it that way, not at all. The data actually shows that the market values growth about 1.5 times more than it values profitability. So the rule's perfect 50-50 balance, it's just a massive oversimplification. I know it gets worse. The Rule of 40 is completely blind to so many other things that are absolutely critical. It tells you nothing about customer retention. Are people sticking around or are they fleeing? It gives you zero insight into the quality of your revenue. It doesn't care about market conditions, and it's just a single snapshot in time. It doesn't tell you the trend. Is the company getting better or is it getting worse? This might just be the most damning piece of evidence against it. If you look at all the publicly traded SaaS companies out there today, the median Rule of 40 score is only 34%. Think about that. That means over half of these successful public companies don't even meet the benchmark. It's clearly more of an ideal than a reality.
So, after taking all of those hits, where does that leave our once heroic metric? Well, the Rule of 40 has definitely been humbled, but that doesn't mean it's useless. It's just finding its proper place in the world.
Which, of course, leads us to the big question that pretty much everyone in the tech world has been asking for the last couple of years. Is the Rule of 40 finally dead? And the answer is no, not dead, but it is definitely evolving. The consensus today is that the Rule of 40 is still a pretty useful, quick shorthand, but only for a very specific kind of company, a mature business with over $50 million in revenue. For smaller, early-stage companies, forcing them to live and die by this rule can actually kill the innovation they need to become great. So the future isn't about finding another simple rule. No, it's about getting smarter and using more complex models. We're moving toward frameworks that actually weigh growth more heavily than profit, and that pull in all those other critical things the old rule ignored, like customer retention and capital efficiency. Ultimately, the story of the Rule of 40 is a really powerful lesson. It's a tool, a useful one in the right hands, but it was never the absolute truth. It's a great reminder that behind every simple number, there's always a much more complex story. And the most important question you can ever ask about a metric isn't, what is it telling me? But rather, what is it not telling me? Thanks so much for joining me.